today's cardinal lesson is about woohoo, taxes. 2021 standard deduction. So we always start these programs with like, why does this matter? Why are you talking about this? Who wants to talk about the standard deduction? And I can tell you that it matters greatly. And it matters in the work that I do as a financial planner. And it matters a lot for what are average people, even money-wise, maybe a little above average people. This matters a lot. So this is, let me just go over what the numbers are, is from since 2018, 2019, 2020, maybe the numbers were a little bit less. I think they're adjusted for inflation, but for a married couple filing jointly, $25,100. For a single person, $12,500 is the standard deduction. And if you're over 65, you get an increase in this. For a married couple, it totals $26,450. And for a single person, $14,250. And I can't tell you the number of clients that I've served, and I help them with their taxes. I don't actually do their taxes, but I help them getting them to the CPA to do the taxes. And I've got this one lady that she just keeps giving me a box of her medical and dental receipts, and then she gives me all her little tax stubs for her car and for some property she owns. And you know, all of that probably adds up to like $2,000 or $3,000. I helped her pay off the mortgage on her house like 6 or 7 years ago. So she doesn't have any mortgage interest for a deduction. And so every year I go out there and she just insists on giving it to me, so I take it. It's about $3,000 of deductions, or what in the box. And she claims this $14,250, she's got that as a freebie when she starts the year. So just at the very beginning is if you're nowhere near these numbers in itemized deductions, you can just stop keeping track of them. You can just throw them in a drawer in case you maybe have something middle of the year or something. So don't throw them away yet, but you don't need to do all this deliberate gathering if you're going to finish the year and you're going to be at a third of whatever this is. The government in the new tax code that started 3 years ago or 4 years ago is just giving you this on the top of the form. Okay, so the one thing we could talk about the hassle, and then, or eliminating that, and then we can talk about you get this deduction from your income whether you have the deductions or not. So why does that matter? Well, it matters greatly because a lot of seniors live off of their Social Security. And then some people will scoff at that, but they won't scoff at it when they're actually doing it. That when they're a little younger than that, oh, that won't be enough money to live off of. And well, okay, probably not. But what a lot of people don't think about is your Social Security doesn't incur any income taxes if you don't have any other income. So all of a sudden, you know, like my Social Security, if I'm successful in waiting till I'm 70, and then my spouse is getting half of mine as the spousal benefit, we're going to have about $6,000 a month coming in. And if I could figure out a way to make that not taxable, $6,000 a month tax-free is no small amount of money, because if I was working and I needed to net $6,000 a month, I'd have to make like $10,000 a month just to finish the month with six. So a lot of people, and I just have this from experience, even people with a lot of resources, a lot of money, they just kind of live month to month, year to year out of their Social Security. And then these same people, a lot of them, will draw money out of their not IRA savings, or they're just savings where they don't have to pay taxes on it, first for a big expenditure, because they don't want to touch that IRA because they don't want to pay taxes. So the point I want to get across in planning is if you fall into this category or this category, so let's say you're a couple, I'm going to want to make sure that your income other than Social Security is at least $26,450 in any given year. Because if you let the year pass and your income isn't that, this benefit of this deduction is gone. So most retired people are not used to the fact that they have some control over their taxable income. Because if you've worked all these years, people that are working, you're not in control of your taxable income. It's just a function of your salary and what you earn from work. So year to year, you get what you get. But when you're retired, you're not in control of your Social Security. You're just going to get that. That's going to be the same amount and that kind of thing. But then you have this other bucket of money, which is called IRA money, 401k money, that sort of thing. And you're in control of how much of that you distribute to yourself in any given year. So I'm just using this as a floor. I mean, it's just saying that if you're here, if you're a couple, or you're a single person, then we need to make sure that we make withdrawals from that IRA if we have no other taxable income of at least this amount. And we probably want to go over that some, just simply because you're not going to pay much tax on the amount over that. I mean, if you just ever look through the tax rates, which I do, you may want to go over that a little bit, but not so much that you drive taxes on your Social Security. And so just because we take money out of your IRA doesn't mean we need to spend it. We can just move it over into another account and have it available in a later year for a large expenditure. I also have people that don't do this, and they're not paying any taxes, and they go year to year, and then all of a sudden they say, man, we need 50 grand for something, or we got to go buy something, and now they got to go to the IRA. And not only do we have to take out 50 grand, we got to take out 80, so we can pay 30 in taxes to have 50. And now they got an $80,000 income. It's not pretty. And when the numbers get larger, it gets worse. So I really want to make the point that this matters. And it's been my experience that a lot of people are like my client, is they kind of know about this, because the standard deduction has been around since the first tax return I filed back in the 70s, the 1970s. But it used to be something like you'd get $2,500 for yourself, and then you'd get $2,500 for your spouse, and then each one of your kids that were under a certain age, you get $2,500 for them, and then there was some amount of money they just put in. So it was a thing. It was much smaller than these numbers, and it was built up by your number of dependents. And it usually, for me, didn't add up to enough that I could just quit keeping track of stuff. All the deductions I had were much more. And it's still that way, actually, for me, as I'm still claiming and itemizing deductions. Many, many people who are retired are using the standard deduction. And just because they don't have the things to deduct, where they're not using the standard deduction to its fullest, many of them, is they're not taking deductions from their IRA in their 60s and just saving it somewhere else, making it after-tax money, so that would be a place they're not taking advantage of it. And then for the more wealthy people who probably aren't taking this standard deduction because they've just got a whole list of things, what they're generally doing is they're still leaving money in the IRAs, which, because they don't need it, because they're wealthy and they've got all sorts of other sources of income, and they're thinking they're doing a good thing by leaving the money in the IRA, but they're just building up a tax bomb for later years. Now, in my last video, I talked about QCDs and qualified charitable distribution. So all of the people that I've spoken to in this video, and I hope that's you, can benefit once they reach 70 and a half from using the qualified charitable distribution. And even if you're not there yet, even if you're in your 60s or your 50s and we're doing financial planning, you can get in touch with me, and as we do financial planning, we can plan for giving in the future directly out of the IRA, and we can take your charitable giving right off your tax return. So I did a video on that last, and it it'd be beneficial for you to go take a look at that. So I hope this has been helpful to you today, and it's just generally, this is just one issue when it comes to your taxes in retirement, but I think it's an important one to keep up with this from a planning standpoint. I'm Hans Scheil, and I thank you for listening.